What's up, mansion builders? I got Shep, our lender, here today with us, and we got a special podcast. We are talking about SBA funding. So super excited to have you on.
Yeah, appreciate it. Thanks for having me.
Absolutely. So we are here at our Mansion Builder Live conference. We're kicking off tomorrow. Shep is going to be talking to all of our partners about SBA funding. We just got back from touring our neighborhood of mansions. And so you saw it, what was it, a little about 9 months ago, a year ago, when it was just raw land?
Yeah, just grass, big field of grass, and wow, where it's come from to where it is now is pretty amazing and pretty fast.
Yeah, we're about 2.5 months away from being complete. We got all our inspections done. We're ready to throw up sheetrock, and 2 of our 4 mansions on this 8 acres is there.
Absolutely, yeah, absolutely.
So I'm stoked that you funded this, or the bank funded this, but working with you, I tell all our partners about you, and you were here to connect with them and really kind of show them here's the path that I went down and that I actually really like for this type of model, for new construction, for assisted living. So that's kind of where I wanted to go today is have you share on some of these things of, you know, what it's like on the lending side, on the bank side, and who you're looking for as, you know, an ideal buyer or borrower customer for the bank.
Yeah, absolutely. And one of the things you've mentioned that sort of resonates with me is the bank helped fund this, right? We look at this as it's a 25-year investment. We're a partner for the term of the loan. It's not just hey, let's originate a loan and then hope everything goes well. We'll talk to you later, right? We're there on the front end to help you get through the nuts and bolts of things on the front end or in the early stages, and then we also like to be around during the construction process. We're heavily involved. We're there after it funds. We check in on you all the time. I mean, it's important. It's a long-term relationship that we like to build. So
that's definitely true, because I know you came out. I mean, you flew to Texas and walked our property, came to our other assisted living on Mesa and walked that, and we spent some time together. And I think that I had talked to multiple different banks before we decided to go the SBA route, and no one else said, hey, let's go out, let's walk your land, let's take a look at your deal.
Those banks down the street.
Yeah.
And we're across the country.
That's right.
That's an important piece of us. We treat every customer like they're the only customer, and so we go see anyone and everyone across the country for every project we do.
Yeah. Well, I think you guys are the real deal.
I appreciate it.
So let's talk about one of these deals. If you're going to build a new construction mansion, what we build is about 10,000 square feet. It roughly costs about $3 million total development cost. And I would say that's about $2.2 million on the real estate side, and then another about $600,000 to $800,000 on the working capital side, on the business side, some of the reserves, construction reserve, interest reserves that we have.
Absolutely.
On that side as well. So will you kind of unpack what that looks like and how that goes?
Yeah, so if you think about it, a project that's $3 million, generally speaking, there's somewhere in the realm of 10 to 20% down on any given project. So on a startup project, right, there's construction risk, there's lease up risk, but to your point, there's a lot of things that go into it outside of just the construction costs. And so the beauty of the SBA product is we're lending not only on the construction hard costs and the construction soft costs and the land, but also the furniture. There's capital needed for that, whether it's in the rooms or common area, working capital. There's pre-opening expenses while you're working on or working towards getting licensed. There's also the necessity for the operating deficit while you're losing money. You know, day one, you might have one resident, but you're staffing it 24/7. You will lose money for a little while until you hit that break even and then start, you know, winning from there on out. And so there's a lot of working capital that goes into the startup cost that needs to be thought about on the front end before you open up, and then you're like, uh-oh, what do we do? We also provide the capital for all of the interest reserve. So we effectively build into the loan the cost for the interest payment during the life of the construction project, as well as while you're leasing up on the early stages. You really don't need to be making a payment until you have sufficient revenue to make the payment. And that's what we try to encompass in the entire loan project cost. So $3 million, you might think it's going to be $2 million, but at the end of the day, it probably is going to be a little higher than you're thinking because there's a time value of money, and those types of things start to add up.
Yeah, I mean, I had no idea how much soft costs were going to come into this project before I really dove into all these numbers, and then started looking at, you know, 9 to 12 months of construction, and then looking at that interest go up and up and up every month. I'm like, oh dang, this thing adds up. There's a couple $100,000 there of interest reserves during construction and lease up, and there's just a lot of money that you don't really recognize the first time you do it.
And here's the other thing that's interesting about that. Those are assets that we're providing capital towards that aren't assets that are really typically liquidated or recognized in the value from a collateral lending perspective. And SBA is not about collateral lending, it's about cash flow lending. Will this project survive or be successful upon opening and once it stabilizes? So we don't really care about the appraisal value. A hard money loan or a conventional loan from bank, they're always going to have a keen focus on what's the loan to value. And the loan to value isn't necessarily there just when the place is built. You need it to get up and running and stabilized to build that really desired value that you as the owner operator are excited about.
If you're new to this space and you're looking at, do I go to a local commercial bank or do I do SBA, right? I've heard SBA's paperwork is horrible and it's so much harder and all these kind of things that people talk about. The difference for me, the biggest difference, why I decided to go SBA were those soft costs, everything that we've talked through here. I mean, it was literally hundreds of thousands of dollars on my project. And it's the difference between I need to come up with a down payment of, $400,000 to $500,000 or double that, right? If I could go to my local commercial bank and they'll actually give me a better interest rate. But nonetheless, I have to literally come up with all of that working capital, interest reserves, furniture money, all of those things. And it's, for a lot of people, it's the difference between I can do the deal and I can't do the deal. Because you can't come up with,
That's
a
right.
lot of people can't come up with an extra $400,000.
And even if they find a way to do it with other people's money, so additional investors in it, they're diluting themselves. Mm-hmm. And when you want the value creation, you'd like to create or you'd like to maintain or hold on to as much equity as possible. So, yeah, I mean, I've worked at a traditional bank. I've worked in the SBA world now at Live Oak for, 9 years. And there's definitely a large component of what the proceeds are for in a construction project, a startup construction project that just aren't largely accounted for in a real estate loan. You mentioned also that why you chose the SBA product, but also people get nervous about SBA often, but to be frank, it's largely who you work with and deal with. For example, Live Oak does and has been the largest SBA lender for 7 years in a row across the country. We have a team dedicated to the residential assisted living space. If you're having heart surgery, do you go to the general doctor or do you go to a heart surgeon, right? So my point is, pick a partner not only from an equity investor, but also from a debt partner that knows and lives and breathes your space, as well as the product in which they're using or utilizing.
Yeah, I think it's totally fair. I've talked to a lot of people, even some of our partners, who have looked at other SBA lenders, and this is not their bread and butter, this space. And you'll get going down the road with them a couple months, invest all this time, do all this paperwork, and they'll be like, no, I'm gonna pull back. This is not for me. Interest rates just changed, something happened, and we're not gonna get into the assisted living space. And this is what I like about you guys, is this is your bread and butter, this is what you do. And I tell all our partners, hey, you know what, Shep's my guy, he's treated me right. Even our builder really likes working with the bank because he requests a draw request.
Yeah, that says a
no
lot.
joke, the next day, the company that comes out and walks the site, they are literally there the next day after he sends draw requests.
Yeah.
And it's all part of efficiency that even helps me, is my builder subs get paid quickly and on time, which keeps my job moving.
Awesome. We appreciate the feedback.
Yeah. So I want to transition and talk about what makes a strong borrower. If someone's brand new to this and they're thinking, hey, you know what, that sounds great. I love the opportunity. I can make great money. I can really help people. I want to do new construction. What makes somebody from the bank's eyes like, oh, you know what, this is somebody I can really get behind and support and root for?
Yeah, good question. So there's a number of things. Number one, personal financial statement strength, right? How much cash can you put into the project? It doesn't have to be all your money, but can you put some skin in the game to make sure that you're committed to the project? We also don't want you to put your last dollar either, right? You need to have more than $10 in the bank after you put money down. So those types of things are important. The second is local. Being local to the project, particularly on your first one, is uber important. We look at this business as an operating business that operates 24/7 a day or a week. And it's not a real estate business that has operations. It's an operating business that happens to come with real estate. And so we've always attacked it in that way to make sure we have the right people that are local to the market and will be involved in the project on a day-to-day basis. if you don't have direct assisted living or caregiving or oversight or administrator experience in the space, then partner with someone that can help you be successful. Partner with someone that owns one of these or operates one of these. This platform is exactly the type of partnership we look for with people that maybe have the ability to bring some capital to the table, want to be involved, want to do it in their marketplace, but don't have the skill set or are a little bit nervous about how to operate in a sector that has, regulatory oversight. And so this type of meshing of a relationship is exactly what we look for people that don't meet all of that criteria.
Yeah. So as far as the difference between their experience, if you looked at it and you had to prioritize one or the other or both, either some type of business experience or medical experience, or is it preferred to have both?
It's preferred to have both, but that's more like a unicorn, to be frank. The business experience is largely and probably the bigger component to it. And you can always get your administrator's certificate, right, or license, but we don't expect, and you may not plan to be the administrator the full-time, day-to-day, but what happens if your administrator leaves, right? We want to make sure that you know and understand how to do it. You've got time to learn that. This place has to be built, right? You're going through the loan process and the development process, so you've got time to do that. But I would argue that the business side, and particularly business ownership, where you've been successful, where we can look at the performance of that business to see how you were able to operate or navigate the environment to be successful in that. And so I think that's probably the larger component to it.
Yeah, I agree. It's so much harder to learn business, managing people, cash flow, marketing, so many different components there than it is to learn the medical side.
And then a lot of times we have people partner that somebody is the healthcare background, someone's the business background. And yeah, that's a great, at the end of the day, you should look at what strengths do I bring to the table and what weaknesses do I have and how do I solve or oversee or overcome those weaknesses. And that's the answer. You partner with someone that has experience, or if you've got the healthcare background, you partner with someone that maybe has a little more capital that can inject capital. Maybe they're in a passive capacity, things like that.
Yeah, I think an ideal team is three kind of avatars of people. You have the business person or perhaps the real estate person. The other person is the medical type person, kind of a nurse avatar. And the third person is the money person, and they're usually a passive investor. You get all three of those people together on the team, and that's everything you need.
Slam dunk, yep.
Mm-hmm. So you talked about people's capital positions and their personal financial statement. Is there a certain dollar amount? Is there equity they need to have in real estate or other type of assets that are important?
We typically look for after your down payment goes into the project. So again, it can be some from you, some from investors. Mm-hmm. But after that, you as the primary owner, you as the personal guarantor, you as the one that is truly signing on the dotted line for the loan, we want to make sure that you have about 6 months of payment reserves. So if your payment's $20,000 a month on a $3 million loan, I don't know what it would be, but something like that.
Yeah, that's fair.
You probably need to have about $120,000 liquid, a rainy day fund. What happens if construction overruns happen? What happens if it leases up a little slower and you have to fund, some operating reserves? What happens if it didn't go through licensing quick enough? Things like that. Some of those things are out of your control. So how quickly is the state going to come in and give you your licensure? So things like that. So the rainy day fund, that's sort of what we look for. That $120,000 is still available to you. You could go buy a car the next day. We don't suggest it, but the idea is that you've got liquidity in the event of a blip it.
So what I'm not hearing is I need to have a personal balance sheet that says I have enough to cover the loan if things went wrong.
Yeah, absolutely not. That's the beauty of SBA. The SBA provides a partial insurance policy to the bank, and because of that, the bank is willing to lend higher on the loan to cost or loan to value. And in addition, you don't have to have the strength of a personal balance sheet of that you would, for example, on a traditional commercial bank loan.
So and correct me if this is wrong, but I think you told me this before, that you analyze the deal, you look at people's finances in a global perspective instead of like on a personal level, how you would look at it when you're buying a personal home, right, with a debt to income ratio. Is that right?
Yeah, so we look at it a couple of ways. Number one, we want to make sure the project itself makes sense. So we want to look at the business plan. We want that to include some analysis on the market to make sure if you think you're going to charge $6,000 per person per month, and the market's charging $4,000, we would ask, how do you think you're going to do that, right? Or maybe it's the reverse. So we look at the pro forma of the business to make sure first and foremost that makes sense, and that you've done a market analysis to substantiate it. The second thing we'd look at is, does this business need to put food on your table, or do you have some other business, or maybe a W-2 elsewhere, or something else that you have some other income that can help not put too much reliance on this putting food on your table? Because the debt to income is a part of the analysis in all, but it's not the sole thing.
Yeah.
And then lastly, we do look at the global scenario, right? So this project, your other businesses, any and all other income streams. So that's the type of stuff that we're looking at. It's all of it, but first and foremost, does the project make sense in that market based on that pro forma and that market analysis?
Mm-hmm. Yeah, absolutely. So another thing that's important is you don't want to quit your day job. If you have a W-2, you need to keep that job up until some type of kind of transition period, right?
Yeah, and that's the part that's hard to figure out. We want you to be active in the business. You're going to do it in your local market. We want you to be active. But if you're working 50 hours a week somewhere else, you probably can't choose, or you probably can't do both. You have to choose. And I understand that. That's fine. Hopefully you have some other income stream, because you can't really leave that while it's under construction and it's got to lease up, and you need to be frugal with your cash and not have to pull it out to pay your personal mortgage or rent and car loan and student debt and credit cards and obligations, etc. So there is a fine line. A lot of times we find that people have flexibility in their current job, whether it's another business they own, where they sort of have the right people in the right places to where they can quasi take some income from that, still be active there, but also work their way into being more active in this. Yeah. And the other thing I'd add is, once you have one of these things, that's great. But a lot of people want to have 2 or 3, and they think about that expansion, and at what point can I fully divest from working for someone else and fully have a comfortable lifestyle that I'm looking for working for myself? Yeah.
Well, this is why I think the team is important. And sometimes it's just a husband and wife team. And we've actually partnered with a bunch of people where you have one of the husband is a real estate person, a business person, and the wife is a nurse or an admin or something like that. And we show them how to go raise money, right? And you have the full team right there. And so you'll see one of those people, keep their W-2 job up and through opening to get to a certain place when it's just like, okay, now the income's coming in, now we're stabilized, and now we can say, I'm quitting, I'm firing my boss, all that kind of stuff.
Everyone has the perfect arrangement. That is the perfect arrangement, where you have a spouse that brings something else to the table that can help keep a steady income for the household. What you just alluded to is perfect.
Yeah. The other thing that I see, we touched on how the bank will lend the first, say, 6 months of interest reserves after you've opened. And when you put everything into the performing, you look at everything, you only really lose money the first month or 2. If you can bring in 3 residents, you're pretty much making just a tiny bit of money. And then by that, if you bring in like 6 to 8 residents on our 16-bed mansions, you're getting up there into the 20s. By the time you're full and stabilized with 16 and you're not still making that mortgage payment yet, you're cash flowing like 50, 60 grand a month until you're stabilized. So what I really like about it is it can really accelerate that time of I'm going to work crazy hard for those first 3 months, get everything stabilized. I might even be working my real job, my W-2 job, but it's only a 90-day period. It's a really hard 90-day period, but it goes by in a flash.
Right.
And then you can quit that job.
That's right. And what we like to do is prepare for the worst and hope for the best. If we short you on the working capital or the interest reserves during the lease-up period, it's a lot harder to go back to the well and re-qualify for additional debt when you're like, hey, I can't make my payments, I don't know what to do, help, versus let's plan for the worst. Can you afford the payment on the worst case scenario? And then if you don't need it, then that's great. That's perfect. That's a good problem to have. If you're beating your pro forma, and maybe we looked at the pro forma and adjusted it a little bit to be a little more conservative, then that's a phenomenal problem.
Yeah, absolutely. So let me ask and talk to you about a couple different things before you get to the SBA, right? And we had conversations and proposals back and forth, probably 3 or 4 of them before we actually got that firm loan commitment. So some of the things that we had to do, and I think a lot of it would be the common path if you're going to build new construction, is we had to go through and get full plans set, right? And talk to an architect and an engineer and spend all of that time, months honestly, going through revisions, getting everything the way we wanted. Then submit that for permits, right? Another set of several months going through all that kind of stuff. Then also finding a builder, right? Getting a hard bid for all of these things. And we had all of that kind of packaged together, and we had conversations back and forth, and we had kind of loose negotiations on here's what all the numbers are and everything, but we couldn't get to a firm loan commitment until we had hard numbers to give you and then ordered the appraisal. And I think that was kind of the key component there at the very end for you to come back and say, hey, Brett, okay, here's our firm, loan commitment and all of that kind of stuff. How does that go from your side?
Yeah, so it's sort of a catch-22, right? You want to know if you're going to qualify on the front end, but you don't really have all your stuff together. You're saying, hey, I'm going to buy a piece of property for ballpark this amount of money, and I think it'll cost ballpark this amount of dollars to build it. A lot of times people don't have any level of plans. They just think it's going to be 6,000 square feet, 10,000 square feet. I think it's $200 a square foot. They haven't talked to a GC, or they did, but they haven't actually gone through any specifics on it because no plans actually exist yet. Mm-hmm. So we can give you a sense on whether it makes sense and understand the market from your analysis that you've done to give you a soft proposal yeah, this makes sense, this should work, but we need to really dial into these numbers. And then as you get further along in the process and actually have those plans and specs and can bid it out, because this market's going to cost something different than that market. I mean, it just makes sense. Depends on where you are in the country. This property in this area may cost a lot more than this one in this area. You may want to buy a parcel that's big enough to do a phase 2. You got to factor those types of things in. And so if you already have plans, then it's a lot easier to engage a builder on the front end because number one, they think you're more serious. And number two, their accuracy is going to be way more so considering they're actually looking at something that's way further down the road than that of a concept or something that's in your mind. So the designs that you've put together, I think anyone that could utilize those will be able to move through that process quicker.
Yeah. I mean, when we were going and getting plans ready, but they weren't finalized yet, and then talking to builders, a lot of times, even when I had full plans, the first number you get from a builder is some very round, super high number. They'll say, oh, it's $250 to maybe $300 a square foot. Or in some markets, they might say $200 to $250, something like that. Right. But that's not a real number. That's just that's a guesstimate, right? They're putting so much fluff and safety in that kind of stuff. And a lot of times, those numbers are so fluffy and big that you get discouraged and you can't even do the deal. Because, I went from numbers of, hey, $250 a square foot down to $170 a square foot. The difference was I'm not looking at one number, I'm looking at 20 different subs that all have an itemized bid that we had to spend months going sub by sub by sub and saying, hey, why is my HVAC guy charging me $350,000, right? We got that number down to 126,000. And it was literally just months and months and months of going through that. So there was a lot of time, honestly, before I can come to you and say everything is ready, right? Here's the real package, and then permits itself, right? Permits can be months.
That's right. So one thing I'll mention is typically, if everything's ideal, the loan process takes 75 to 90 days because you're effectively shovel ready. You have those dialed in numbers for plumbing and electrical and et cetera. You're basically ready to pull the permit, the final permit. But the reality is, this is typically your first or second or third venture. You're not doing this for your 50th time. You may want to engage the bank earlier to help guide you through the process on, am I going to qualify softly? What steps do you recommend from here? And we can be a sounding board. The reality is we're engaged on a construction deal quarters in advance. And we are a sounding board and effectively a partner to help you get to the closing stage and then fund the loan. And then we're a partner for 25 years. So we don't mind that. We expect that. We look forward to it. That's how we build our pipeline, to be frank. And also build, rapport with those that we are working with in the lead stage, if you will, or in the early stage.
What about the people that are kind of in the gray area? They're just maybe you qualify, maybe not, I'm not sure yet, and they have to go through all these different steps and work. How do you tell people that, and what do you say?
So that's a good question. I would probably say if there's a maybe component, where are you having the shortfalls? What things are you not exceeding on? Is it the lack of business experience? Is it the lack of capital to put into the project? Find other investors. Is it no marketing experience? Who else can you bring on to your team to help you be successful? So I think largely, if you feel like you're on the fence, or we tell you there's probably a cap here, then we'll be honest with you, because we don't want to waste your time to spend money. And that's also why we don't mind getting involved earlier. But at the end of the day, it could be the difference on, you might qualify for $3 million, but you may not at $3.5 million or $4 million. And it's sort of a catch-22. Are your numbers rounded to the nearest 100,000 on every sub or trade, or are they dialed in to the nearest 1,000? And so I also think it helps when you get to the construction sizing phase. Be honest with the general contractor. I'm gonna get another opinion. Let them know that you're competing. They're competing for your work, which may force them to dial in a little more aggressive. If they want to win your money or win your business, it's important that they earn it.
So one of the last things that happened prior to getting our loan commitment from the bank was that appraisal. Can you talk about the as-complete appraisal and what that looks like?
Absolutely. So on the as-is, there's two things we look at. There's an as-is value. What is the land worth today if you own the land? Otherwise, we're probably closing on the land at closing, which is often what we do as well. But then there's the as-complete. The as-complete is what's the value of the parcel with the improvements, the business included, or the furniture, which is nominal, but it is a component of it. And that's where we get comfortable on the collateral value. From an SBA perspective, there really isn't a collateral loan to value that we're largely worried about. We do loans all the time that don't appraise out because SBA allows us to. Programmatically, we're allowed to. There are other ancillary collateral rules that require us to take additional collateral should your project or property not appraise. And if that happens, then we have to figure out how to address that. But at the end of the day, we can still do the project. It's just, do we have to attach some kind of additional collateral in those scenarios? Most of the time, these things appraise for above and beyond the construction cost, because you're creating value from a piece of dirt to a finished building that now the next person could just move into. They don't have to go through the time, effort, and headache to go through that project development.
Yeah, absolutely. We're building at like almost 55 to 60% of future value. And you think of it like a home builder, right? Like if they're selling a new construction house at $300,000, they're not selling it at $300,000 because it costs them $300,000. Right. It probably costs them $150,000 plus, their overhead and things like that, right? You're really building your equity, and that's why I love the new construction side, because I guess it kind of wraps me into this next part. So we're building. Our as complete came back at like 13 million or so of 2 of our 4 buildings, and we put a lot of site work and stuff in the front side. But we're going to come back in a couple of years, do phase 2.
So yeah, it's a great segue into that. So now you've created a ton of value in the first ones, right? So when it comes to phase 2, we very well may do phase 2 with nothing out of pocket, because you've built up equity and you've built up probably excess or sufficient cash flow to be able to afford fully financing the next location or the next phase in your case. So that's the beauty. Once you're successful on one, create additional equity, have excess cash flow above and beyond your debt payments. There's no down payment requirement on a go forward. We often are doing expansion locations, whether it's on site on the same parcel, down, or somewhere else, quite frankly, even in the state, and people aren't putting anything down. I mean, that is a true benefit of SBA. Think about your first one. First time doing this, you've got construction risk. A lot of times it's the first project someone's done anything with construction. They've got lease-up risk. They've never owned or operated one of these. Now you want to do a second one, whether on site or elsewhere nearby. You've got construction risk, but you're a proven owner-operator. This whole thing, if you remember what I said earlier, is we look at this as an operating platform or business that comes with real estate. Well, if you can prove you can run this business, then we have a high degree of confidence in you, and we're happy to give you higher leverage on the next locations.
Mm-hmm. So talk to me about practically how do we do this. And right now we have one APN. So it's 8 acres. It is all one parcel. And you've mentioned this before about SBA will go into a second position, right? Because I can only do one SBA loan. So I would need to cash out, refinance the SBA loan that we have together, go to a local commercial bank, get a new loan there, and then take out another first or primary SBA loan for phase 2.
Sort of. We would hope that we refinance the loan conventionally.
Okay.
Right? So you
If
could
you
use
give me
another
good
bank.
terms.
Live Oak can do it too, you know? Because now you've got a stable asset.
Uh-huh.
You've got proven track record. You've got great loan to value. It's a different scenario than when you were applying with a piece of dirt. Right? It's a
There's a
different
lot
risk
less risk.
profile. Right? So in that scenario, I mean, we're doing one right now that we will refinance the existing SBA loan conventionally, and then we will do a new SBA loan on top of that for the expansion for the next location on the same parcel and their phase 2. I mean,
And
that
you're
literally we're
in a
doing
second
that.
position?
We're in a second position on the SBA loan. So we will do that. That'll close in the next 20 to 30 days. And that way, because every time you pay off the SBA loan or pay down, it re-ups your runway with SBA. With SBA, you have a $5 million limit on an SBA 7A product. Live Oak, and you would know this, will go above and beyond that. So if you're doing 2 homes and you need $6 or $7 million, that's fine. We'll find a way to make that work. We'll give you $5 million through SBA, the 7A product, and then we'll give you another couple million conventionally, still at the leverage terms that you're looking for to help it become a desirable and feasible project to fund at an attractive leverage point for you, the owner-operator.
So for us personally, we had 2 loans. We did a $4.8 million SBA loan, and then in second position, we had a pari passu loan of $2.4 million. And so it was because we're doing 2 phases, but we're also stacking a lot of the capital in phase 1. We're actually doing about 2/3 of our entire development because we had to include the land cost and all of the site work. We have this huge road, all these utilities and stuff to have to go in. So actually our phase 2 is only gonna be about 1/3 of the project versus 50% of the project.
That's right. But you're likely to create twice the value.
Yeah, absolutely.
So that's the great thing about a phased approach. You're not taking on the risk of all, in your case, 4 homes at once or 64 beds at once, right? You're stair-stepping it to where it's a nice risk reward or tolerance and step into making or adding additional locations. But to your point, yes, and that's the case. I mean, that tends to be the issue on when you buy a parcel that you can expand on with additional buildings later. You're going to be front-loaded on both the real estate cost as well as the development cost. And the development cost tends to be the higher component of that. And so that may force you to have to put in a little more capital on the front end because you're really intending to share that cost among all of the project. And can your pro forma afford all of that front-loaded cost? That remains to be seen once we look at each and every opportunity.
Yeah, that's a good point there. You gotta make sure that everything cash flows with the extra cost there. So a lot of our partners are buying 5 to 10 acres, right? And they're following in our footsteps. They're building 1, then they'll refinance, build number 2, and get to a place. It might be 8, 10 years down the road, right? You build out your whole neighborhood of 4 of these, and you go and exit the deal to sell to some big corporate or REIT or something like that. Do you think from a bank perspective, if you're going to do multiple phases, not just 2, but 3 or 4, that it is better to go in and plan and subdivide the land prior to starting the first part?
My gut says it's going to depend on the municipality and what they make you do from an infrastructure perspective. So I don't know that I'd have the exact answer on a per deal scenario. It's probably hard to justify the upfront development cost of 4, where 4 buildings will eventually be, and figure out how to make that work from a loan or from just a cash flow perspective on 1 home, for example. 2, I think, can be done. You know, some people, if their plan is to only do 2, or at least initially 2 on 1 parcel, maybe they'll do another 2 in another part of the town. But in that case, you could probably even expand easier, right? You do the first, let's just say they're $3 million loans. You do the first loan for $3 million with an SBA loan, an SBA 7A loan from Live Oak. And then when it comes time to phase 2, there's no need to refinance or restructure because there's still another $2 million of SBA availability. And remember, we have conventional money too that we can pair with that. So we'll just give you another $3 million through SBA and conventional, or whatever the cost is at that point in time. We can do a couple million. And that way it doesn't disrupt and create other transaction costs you have to do. And we're in both the first lien on that parcel for the existing or the first SBA loan, and then right behind it on the second. Yeah. And then if and when you run out of SBA runway, we will find a way to help you refinance conventionally, because you should be a different, it's a different opportunity then, like I said earlier, right? You've created equity, you've got hopefully solid cash flow, right? It's a different risk profile, and you probably will qualify conventionally. We rinse and repeat with another SBA loan, and that's typically what we do on a day-by-day basis.
Yeah. Well, Shep, I appreciate you being on here. I think this was super helpful to a lot of people. And again, reach out to Shep. How can people reach out to you?
Absolutely. So obviously phone, email works, liveoakbank.com. Literally, if you go to our website, we are a verticalized bank, meaning we lend to 35 industries, and there's a dedicated team to each of those 35 sectors. So there's a few of us that cover all 50 states, residential assisted living. If you go to our website, it will direct you to us if you choose assisted living or residential assisted living. But we'll happily give out our phone numbers, emails. It makes no difference to us.
For all of you thinking about doing it, I encourage everyone to do a bigger deal, a life-changing deal. Don't do one of these dinky little RELs that keep you trapped in your business, right? Spend the time, find other people's money, put in the work, and do one big life-changing deal.